So Prashant, the first question I'll ask you, and this is something that we often, our clients have been asking us, and it's about the Fed raising rates and the potential impact on Indian equity markets. Prashant, you're on mute.
No, obviously everyone is aware Fed is raising rates, and everyone's aware that everyone else is worried. And it's always on the CNBC as well, and has been for some time. But if you look back at evidence, historically, there is no evidence to suggest that during Fed rate hikes, the US market or Indian market does poorly. In fact, what evidence is there is contrary. So it's really perplexing. What we've done here is on the slide looked at the prior 5 times where the Fed's gone on a rate hike cycle, starting from 1988, which was quite steep 300 bips increase, probably similar to what is expected now, or even worse than what is expected now. And you'll see that the average performance for US market during the 12 months following the first Fed hike has been plus 6.7%, which is in line with, call it 7%. 7% return is in line with what the US market has delivered over the last 40, 50 years. I mean, this century, since 2000, US market has delivered 5% return, all right? So, and over longer time periods, it's 6, 7% in that range, which is nominal GDP plus dividend yield. And so during 12 months following the start of the Fed rate hike cycle, the returns being just in line with the longer term averages. And coincidentally, each and every time they were positive as low as 1.9% to 12.4%, but positive each and every time. There's not much volatility actually over a 12-month period following start of the Fed hike cycle. Interestingly, the Indian markets delivered, this is just, coincidence, I would say. You can't expect the market to deliver higher returns just because Fed is hiking. But interestingly, during these 5 time periods, Indian markets delivered 20% on average in dollar terms, which is substantially higher, almost 3 times higher than what the Indian market's return has been on average in dollar terms. So over the last 22 years, at least, Indian markets delivered 6% dollar term return. And over longer time periods, it's similar in dollar terms, 6, 7% return. So at 20%, Indian markets delivered thrice its long-term average return over the 12-month period, starting from the Fed hike. I'm not suggesting that is what to be expected going forward. We have only 5 data points. Even if there are 100 data points, you should not extrapolate in such macro matters. But what point I'm making is not that the markets would do very well, US or Indian markets would do very well going forward during Fed hike cycle, but the point is there's no empirical evidence, no factual evidence to justify the almost hysteria-like situation that in media and amongst investor newsletters and investor discussions that prevails related to the Fed hike. The underlying assumption, prevailing assumption that everyone has is that historically during Fed rate hikes, all markets have done poorly. But evidence is very contrary to that assumption.
Rohit, there's a question for you. The question is around, since you meet a lot of consumer companies, what are you hearing from them on supply chain disruptions or any slowness in demand, etc.? If you can just kind of speak about that.
Sure, Vivek. Thanks. There are 2 separate issues, supply chain disruptions and demand, and I'll take supply chain first. I think at the margin, supply chain disruptions are easing. That's what we are hearing from companies that we talk to. And if you really look at the last 2 years, right, where we've seen meaningful supply chain disruptions around the world, the larger organized companies have actually, you can argue they've benefited, because the smaller companies, struggle, whether it is unorganized or smaller organized companies, regional, local companies, they actually tend to struggle on two counts. One, they are not large buyers of some of these quote unquote, either commodities or intermediary products. And to that extent, their ability to source, because they don't have diversified sourcing base, right? Their ability to sort of go out and get those raw materials is rather limited. So larger companies tend to benefit. And number two, there is a working capital, aspect to this as well, because as commodity costs go up, there is a higher working capital requirement. And in times like these, where supply is not, there is an inherent uncertainty when it comes to supply of some of these raw materials, you actually want to stock more from a strategic standpoint, which actually puts an even higher burden from a working capital standpoint, right? So larger companies with much stronger balance sheets can actually go for the strategic sourcing. Their ability to source, their ability to fund these higher working capital requirements is greater. And to that extent, even in the last 2 years, at the peak of some of these supply chain uncertainties, we haven't seen any meaningful instance of a large company, right, in any of the categories, right, on the staples or discretionary side, see stockouts, if you will, right? The retail shelves always had, the large brands, the products were always available, right? It was the smaller companies that struggled, which has sort of reflected in, market share gains for most of the large companies. If you look at, data that some of these syndicates like Nielsen, Kantar and all report for overall market growth, right, versus what the larger companies have been reporting, the listed entities have been reporting, right, in terms of their growth, right, there is a clear positive delta in favor of the organized companies, right? And that essentially reflects that these companies are gaining share, right? Not necessarily from other organized companies, but more from unorganized, regional, local companies, right? So that's that. The other aspect to the supply chain question is the cost part, because freight rates had also gone up. So for a lot of these imported raw materials, there was a cost push on account of freight as well. So at the margin, in the last few months, things have started to improve on that front as well. Of course, we are nowhere close to the pre-pandemic levels. So there is still a long way to go for the pressure to ease out completely on that front. But things have started getting better, both in terms of overall supply chain as well as supply chain costs. Yeah, so availability of raw materials as well as cost of freight, both are moving in the right direction, or both are easing, let me put it this way. But are we back to the pre-pandemic normal? Not yet. Yeah, and your second question was really on what's happening on the demand front. I think like many things in India, it's there's no single answer, right? We've all heard of this letter K in the last 2 years in a lot of contexts, and even in this context, I think the letter K applies. So there are parts of the market where demand remains fairly resilient, right? So this would be, and whether it is staples or discretionary, right? It's even some of the discretionary categories, which let's say cater primarily to middle class and above, upper middle class and above, right? Some of those categories continue to do extremely well. Right, you look at the bounce back that has happened in air travel. You look at the numbers that have come out from a company like Titan, for example. Some of the other consumer discretionary categories. We've seen a couple of QSRs report in the last 2 days. Right, McDonald's reported its best ever quarter and very strong growth over pre-pandemic levels. Right, so that's one side of the equation. On the other hand, there is stress in the rural markets, which is impacting some of the staples companies, because volume growth for a lot of these highly penetrated staples categories actually comes from rural markets. So some of these higher penetration categories, we have seen volume growth numbers go down, and the source of that volume growth is rural and rural markets. There is clear downtrading in terms of pack sizes, not necessarily downtrading in terms of brands or price points, right? So people are calibrating, their or titrating usage of certain products. Right, so that's one way in which demand slowdown is showing up. We haven't seen meaningful downtrading in terms of people moving from brands back to unbranded or regional or local products. That I think is very encouraging in some sense. That hasn't happened. And lastly, premiumization in certain categories continues. So again, as I said, different ways to cut it, but overall, I think it's a bit of a mixed bag from a demand perspective, though commentary in the last couple of months from most companies, has started trending more in the positive direction. There is a hope that good monsoons this year, and in general, because of this phase of agri inflation that we saw, I think the expectation is that, and I think the government has also quote unquote protected the farming households to some extent from inflation and so the agri inputs, if you will, right? Whether it is fertilizers and some of the other inputs into the agri value chain. And to that extent, the expectation is that the overall household financials of an average farming household will look better in the coming months, and we'll perhaps see a better second half or some recovery in rural demand also in the second half. Urban demand has been more resilient anyway, so expectation is that demand will improve from here on. I hope that answers the question. Back to you.
Thank you, Rohit. So Prashant, coming back to you, and I'm kind of combining a couple of questions here. This is a follow-up to your comments earlier on the performance. The question is around, in periods of underperformance, will we change our approach of looking at different ways and generating alpha? And I think a broader question is, why invest in our PMS? Will it generate alpha, or are clients better off buying a passive fund? Prashant, you'll unmute yourself.
So two very different questions. First, let me take the latter one, and I saw some questions flash on the screen as well, worded differently, as some of the investors on the call might have invested during the last 6 to 9 month period, and someone might have invested also on December 31st of 2021. And unfortunately has only seen the underperformance period. So the question, understandably has come from that perspective. So see, we have a fairly long track record, and if I were to give, and not to be flippant about it, but I'll go in more details as well, but just to give you an analogy, as I always give cricketing analogy. But if you are, as I always say, investors are like IPL team owners, right? An IPL team owner identifies with a lot of analysis and work and expert advice. They identify at the start of every IPL season, 15 odd players, right? Similarly, you identify several managers, maybe not 15, but whatever number, with a lot of analysis and advice and good work. Now think of an analogy where in IPL, there are 14 games in the league season, leave aside the finals, semis and all that. Now if in the first match of the season, if a batsman gets out on 0, it's not necessary that was a bad decision that you made in selecting that IPL player. 0, 5, 10, whatever runs, right? It's the first game out of the 14 game season, as an example. Even Tendulkar has been out on 0 14 times in his career, right? And so early on in the 80s or 90s, if you've gone to see a match and Tendulkar ends up being out on 0 and you write him off, that would have been a very bad conclusion, wrong conclusion. So you have to reassess. I'm also not saying, oh, just because of that, you don't do anything. You have to reassess. 6 months ago, 8 months ago, 9 months ago, there were certain considerations that you might have used in evaluating investment with our team. And it may be appropriate to reevaluate and see whether those considerations as of today are appropriate as well, with this additional 6-7 months of information. Because we also have clients who've been with us for last 5 years, and in fact have been clients of mine earlier at different firms for previous 10 years, and they have large sums with us, and in fact have, because certain clients who are very large, we don't take more money from them from a risk perspective, risk diversification perspective. We don't want a particular client to be extremely large in our, beyond a certain point, large in our client base. But just late last week, earlier this week, in fact, one of such clients whom we had said no earlier to their request for increase in assets with us last year, they came back to us after a similar review that we are having today and that we had with them earlier this month. They came back to us earlier this month and requested again whether we would reconsider and take more money from them. Now, they are very different client than, let's say, someone who's invested money with us 6 months ago, because that client has observed us or observed me before White Oak and now observed the White Oak team, and collectively more than a decade, they've observed us invest money with us. And they've observed that every 18 months, something like this does tend to happen on average. Over the last 10 years itself, this is the 7th time that such a drawdown has happened. Okay, now maybe this 7th time has coincided with the date of your investment, plus minus few months, right? But what our team would generate going forward would be a function of just not what has been delivered over the last year to date, 7 months or so, but a function of the same caliber, same philosophy, process, risk management and portfolio construction approach, which has helped the team deliver over the last 5 years top ranking performance. So let me share with you, earlier this year in March, the team won the, it's not the team, but the fund, our UCITS fund, which is the mutual fund that we offer to investors globally, Dublin domiciled, that won the Best India Fund Award by Lipper. Lipper is the most respected of such rating agencies. Like you have Morningstar and others, Lipper is extremely highly regarded globally. And we won the Best Fund over a 3-year period award. 2 weeks ago, we also won the Best Fund Award by Investment Week. Investment Week is also highly regarded in certain segments of the market, particularly pensions and institutions. Now, these are for funds that are outside India. I'm not talking about PMS or AIF. So the peer group is different over there, but it is a large peer group, 40, 50 managers across board. And over the last 3 years, the track record, 3 years, 5 years is extremely strong. So even, Tendulkar or even Dravid might have scored an average of, Dravid is considered the most consistent, right? Tendulkar scored probably at an average of higher than Dravid, but Dravid's considered more consistent. But it's not that if Dravid's average was 52, he scored 52 in every inning. Some of the innings he did get out in single digits, and in other innings he scored double century or triple century, right? It's just that the match that you went to see, Dravid or Tendulkar, let's say they got out too early, doesn't mean they're bad batsmen to watch, but it might be more shorter term. Now, so again, I would point out that you have to reevaluate though. I mean, obviously you can argue some batsmen go out of form at a certain point, right? So that's something that you should reevaluate, whether we have gone out of form. We don't think so, because good thing about investing is your peak is always ahead of you if you continue to do the right things. It's not the first time that we've had a few months of tough period, but from your perspective, it is a legitimate question. And I think the right way, the right advice would be that you have to evaluate and see whether it is like a good batsman getting out early on one bad day, or is it out of form going forward? Obviously, in my biased opinion, I would say it is the former, and it's a variety of factors that we talked about. Obviously, we presented all the analysis on why the performance has been challenging. It's not just we are just saying, oh, 6 months poor performance, it will be fine and fixed. We've said every time something like this happens, we have underperformed in the past. So if over the next 6 months, utilities and energy and government-owned companies again were to outperform the market by 25%, it's quite possible we would underperform. Let me be clear about that. But there are not too many times in stock markets history anywhere in the world that utilities and energy and government-owned companies outperform by 25% and then again outperform in the consequent 6 months by 25%. It's not impossible. Can't rule out going forward, but that's what I'll say. So that's the first one, Vivek. What's the other? Sorry, that was the second answer to the second question. What was the first one?
I think, Prashant, the first one was along the lines, and when we have underperformance, do we change our investment process or philosophy or take any top-down views?
So see, change is a very strong word, but the question is very, very, pertinent. See, in investing, you learn every day. That's the best part about it. I've been investing professionally for 25 years and including individually for now 37 years. Most exciting thing about investing is that you learn every day and you evolve every day with the learning. Otherwise, you're not learning, right? So every downturn in the market, every crisis in the market is great learning opportunity, like 2008, COVID, demonetization and all. And every time of underperformance also is a learning opportunity. Every time of outperformance is also a learning opportunity. Probably you learn more during underperformance about certain aspects, and you learn more about certain aspects during outperformance. The core investment philosophy hasn't changed. Hasn't changed over the last 6 months, hasn't changed over the last 6 years or longer time period of great business, attractive value, and so on. It can evolve on the margin, but in this particular instance, let's say, there's a risk management and alpha generation. Yeah, there's always a trade-off between how much alpha potential you have and how much volatility of alpha the portfolio would have. Now, that trade-off, there's no single answer as to this is the right trade-off, right? Over the last 5 years, I can talk about at this forum, but if you were to look at Bloomberg and look at the past track record, there's been a very highly consistent performance track record. I would say it's been a strike rate stronger than Tendulkar and consistency far superior to Dravid. But yet there are periods within that. While it is most consistent, doesn't mean it's like fixed income, right? It's most consistent means it's most consistent compared to everyone out there, but doesn't mean in absolute terms it is like fixed income. So when during past periods as well, there has been underperformance, it has been a time to evaluate whether the trade-off between magnitude of alpha and consistency of alpha is the appropriate magnitude. And if it is not, whether there has to be recalibration of that trade-off. Now, one way we can bring in more consistency, as an example, is buy some energy stocks, which is basically Reliance, buy some utility stocks, which is, let's say one of the Adani Group companies, buy some government-owned companies. We can bring consistency to the portfolio, greater consistency, because these are the big underweights and would make the portfolio returns, if something like the last 6 months happened, more consistent, and reduce the mid caps in the portfolio, have more large caps, right? All that would increase consistency. But as a trade-off, that would somewhat blunt or reduce the alpha potential. And you have to think about that trade-off, whether it's worthwhile to do that trade-off, or is it better to tolerate over 3, 6, maybe even 12 months, some underperformance from time to time for for retaining higher alpha potential over longer time period. Right? If I were to just arbitrarily give numbers, we have about, say, 25% underweight in these areas, that is energy, utilities, government-owned companies, yeah, and some other small ones similar to that. Now, if we want to reduce the volatility of alpha, we can buy 10% in this out of 25. So the risk would become 20 instead of 25% underweight. The risk would become, yeah. So this is, so just go to the previous slide and the slide previous to this. So this is a very important question, taking a little bit longer. So from a portfolio construction risk management perspective, the aim is to ensure performance is a result of skill rather than chance. We have a balanced portfolio. That is why focused at stock selection. We consciously avoid market timing and sector rotation and all such top-down bets. But there are, as a result of our portfolio selection and I mean stock selection philosophy, there are certain residual factor risks that are byproduct of stock selection. That we tolerate, right? And we understand those are risks, a factor risk, but you cannot zero out. It's not optimal to zero out every risk. And the reason I'll explain in the next slide, next two slides. If you go to the next slide, the two major risk factors in our portfolio are, first, the higher degree of mid and small caps. And the reason we have a higher degree of mid and small cap in the portfolio is, please remember, not because we believe mid and small caps would do better than large caps. We never have thought or believed so, and never say so. It is our belief that all large cap, mid cap, small cap, ex ante, can be expected to perform the same. Index performance would be the same going forward. However, universally, not just in India, but in US and the dozens of other markets that I've invested over my career, it is true in every market that mid and small caps are more inefficient segments of the market compared to large caps. So if you're doing your research well and fundamentally adding value, then you can add a lot more value in mid and small cap. Obviously, if you're not doing it well, you can lose your shirt. And there are so many managers who lose their shirt and then their clients' money in mid and small caps. So important thing is not that just because they're more inefficient segments, more value can be created. No, not true. Those who can create value can create more value, but there are many who destroy value and can destroy huge amounts of value in mid and small caps. We do believe we can create more value, generate more alpha, and hence we have an overweight in mid and small by about 20%. So there's a big risk factor to be overweight by 20 to 25% in mid and small. But we do so because we have now 5 years at White Oak and many years of my prior experience that shows that mid and small, the alpha generation is far higher, as I showed earlier as well during the performance attribution. And hence a 20% odd overweight in mid and small is worth tolerating that risk. Sometimes it'll hurt us, like in 2018. And this year, that has been a headwind. But in the scheme of things, in the longer time periods, over time, the higher alpha generation potential is strong enough to tolerate this risk from time to time. This is number one risk. Second, the same funnel of opportunity, you can substitute the x-axis with other variables than market cap. So one of the variables can be governance. So on the red, so it's supposed to be red, amber, and green. So in the red zone are companies with poor governance. In the green zone, companies with good governance. At the risk of generalization, there are certain sectors where vast majority of the companies are poor governance, like real estate. Everyone in real estate sector also agrees that it's a sector full of crooks, right? Even listed companies, they would laugh at it and say, yes, our sector is full of crooks. We are good, but the sector is full of crooks. So you can reasonably say 80 to 90% of the companies in real estate are crooks. I mean, poor governance. On the green zone, on the other hand, can be IT services. Not that 100% of them are good governance, but by and large, companies like Infosys, TCS, HCL, Persistent, Coforge, all these are companies with very solid governance. Now, it is not our belief. Never have we said at any time, and I'm only taking real estate, but I mean, to be politically correct, I'm not going to say other sectors or government-owned companies and all that. Globally, government-owned companies, their governance has been challenged and leaves a lot to desire for, but certainly not something that you can paint a broad brush for every country. And maybe in India it is better. I'm not making any statement on that. But what I'm saying is, we've never said and would be not correct for us to say, and hence we never say that poorly governed companies are going to underperform the better governed companies. No, poorly governed companies trade at oftentimes big discounts, and maybe the valuation takes care of poor governance. But what is our view? Just like in large cap, mid cap, small cap, it is not our view that large caps would underperform going forward. Similarly, it's not our view that poorly governed companies would underperform. It's just that there is less alpha to be extracted in poorly governed companies. There's a lot of randomness in poorly governed companies, which cannot be analyzed or predicted, because poorly governed company means that the controlling shareholder is going to siphon off cash or value in one form or another. That's not something that you can predict, because no such controlling management or shareholder is going to tell you, I'm going to siphon off 20%, 50%, 100% or whatnot. You know, push comes to shove, they may siphon off 200% of the value and leave the company in huge amount of debt. And it's been done several times around the world. So in those red zone, even if you get the business right, you can't predict. It's a random variable how much money is going to be stolen from the company. And hence there's no sanctity to any cash flow based valuation approach, which is how all valuations are ultimately. And hence, because of that randomness, the alpha opportunity is very low. So in large caps, the alpha opportunity is low for a different reason. In poorly governed companies, alpha opportunity is low for a different reason. And hence, in mid and small, there's higher alpha opportunity for a different reason because of inefficiency in the market. Along the governance spectrum, the alpha opportunity is higher in good, well-governed company for a different reason. But greater proportion of the portfolio is in better governed companies than in poorly governed companies. So what that means is, when poorly governed companies rally as a basket, which is what they've done this year, when poorly governed companies rally as a basket, it would be a headwind to us. And this red zone is like 25% of the market, right? So we are about 25%, 25 to 30% of the market, and we are 25% underweight. When they rally as a basket, we are going to lag behind. It will be a headwind to us. We may or may not underperform depending on how strong this headwind is. If the headwind is extremely strong, like it has been this year, we would underperform. It's like, if to give you a different analogy of a different game, not cricket, but it's like, you know, if you're playing soccer or football, if there's a light headwind, your side can still push the ball ahead and score a goal on the other side. But if you have a hurricane force wind against you or a tornado force wind against you, you just can't kick the ball to the other side. And sometimes, like year to date, you have such very strong headwinds where both the mid caps been a headwind to us, small and mid caps have been a headwind to us, and this poor governance has been a headwind to us. So to change our approach would be to start then forget about the well-governed companies and higher alpha potential mid and small, chase what is working, chase all these companies who are just selling. That, while in theory might sound like work, but if that kind of an approach were to work, everyone would do that because it's relatively easy to do. That does not work. That's what often retail investors do, and certain managers also do. It works for a few months and then it unravels. You know, there's no standard recipe in that sense that what is working would continue to work, or what is not working will then turn around and work and all that. So we have, to the question, we have stayed consistent with our philosophy and approach of having 40% odd in mid and small cap, which we had a year ago, which we had 2 years ago, which we had 3 years ago. And we've stayed consistent with our approach of not owning poorly governed companies. Now, 25 to 30% risk is tolerable still. If the poorly governed segments of the market again outperform by 100%, let's say, and they become 50, 60% of the market, then from a risk management perspective, we might end up buying some of them because they might become 80% of the market. Because in countries like Russia, China, and all, poorly governed companies do make up 50 to 80% of the market. And if you're managing money in those countries, you have no choice but to pick the least of the devils. If India were to end up becoming like that, we would also consider for risk mitigation buying such companies. But so far, fortunately, in India, there are still a lot of companies to pick and choose from with good governance in small and mid as well as large caps. So longer answer, but hopefully that helps. Certain segments like metals, we have bought a couple of names because there's another, because just size and governance are not the only variables. There are several others, and the interest of time would not go over all of them, but I would say there are certain metal companies that we have bought and added to, particularly after the Russia-Ukraine war, to mitigate the risk of runaway inflation and complete supply shocks in some of these metals. Vivek,
Sure.
other questions?
Yep. Thanks, Prashant. I think we have time for two last questions, maybe one to Rohit, and then I'll finish with you, Prashant. Rohit, there's a question on the portfolio.
Let's make rapid fire if possible from now so that we can cover as many as.
Sure. So Rohit, we've seen some investments in new listings, including some new age businesses. Just quickly, your thoughts on that.
So Vivek, for us, any new listing is like an opportunity to assess and evaluate a new company which is getting listed. So it's no different from companies that we keep evaluating which are already listed. Right? The investment lens still remains the same, right? So there is no top-down tilt or let's say a predefined bias towards newly listed companies. We evaluate each opportunity on its own merit. So we have invested in a few new listings. And we have not invested in a much larger number of names that got listed, right? So while you'll see us active in overall participation in certain IPOs, but the lens, which is great businesses, which are coming in at attractive valuations, the lens still remains the same. I think Prashant wants to add something.
I understand. See, we are very selective in new listings. It's the large number of companies have gotten listed. It's not that we've invested in every one of them. We're very highly selective, and we have a very strong track record in new listings of identifying the winners compared to the losers. Not every one of them would be winner, but on the whole, we've got very good track record. Third, new listings are also a more inefficient segment of the market. So compared to companies that have been set of companies, let's say like HDFC Bank, Reliance, SBI, and all this, which have been listed for decades, companies that are new listings would be more inefficiently researched because a lot of buy side does not do any work until sell side has come out with large number of sell side has come out with reports. Unlike them, our team does a lot of primary work on them, and we believe we have a greater edge in inefficient segments of the market because we do all the work very proactively, and there's hunger on the team to look for alpha rather than wait for sell side to do the work and serve on the plate. So it is a more alpha rich, potentially more alpha rich segment because of greater inefficiency, just like the mid and small caps. And we would want to, I mean, investors should feel happy that the team is proactive at exploiting opportunities rather than laid back. If you don't see any new opportunities included in the portfolio, one should wonder and ask question whether with so many new companies listed, aren't there good opportunities in there that a manager has found?
Thanks, Rohit. Thanks, Prashant. Prashant, the final question is, given that we've just launched a mutual fund, a FlexiCap fund, what were the key differences between the mutual fund, the FlexiCap fund, and the Pioneers portfolio?
Certainly. So see, I mean, at a very 50,000 feet level, I mean, the two are somewhat, while the investor base is very fungible, particularly anyone can invest in mutual fund, But the center of gravity, if you will, in mutual fund is a retail investor. Whereas in PMS AIF is a higher net worth, ultra HNI, if you will. The distribution is also of different kind. All said and done, the risk appetite is different for retail versus HNI. So I would, what my discussions with Parag, Rohit on the PMS side, as well as Ramesh on the MF side, is that the MF is going to be, so the trade-off between what I said about alpha potential and volatility of alpha. In mutual fund, that trade-off would be somewhat different and would be more tilted in favor of the having lesser volatility of alpha. Whereas in PMS, that trade-off would be more tilted towards higher potential alpha. So if I were to give you one straight example, like we've been talking about energy and utilities and this 25% underweight, it's unlikely that the mutual fund would have 25% underweight in these segments, because there are certain tight risk bands, overweight and underweight bands that are going to be in place in the MF. So the underweight, instead of 25%, might be 15%. I mean, quite likely MF, I don't know, they have not invested in, but quite likely there could be some investment in energy and utilities in MF, because the 10%, 11% underweight in energy would be too much risk in mutual fund context, even though that is not too much risk in a PMS context. So I see that a mutual fund as a more risk managed and somewhat more, the trade-off being somewhat more tilted towards reducing the volatility of alpha. Whereas in PMS, even though we do have less volatility than almost anyone out there in the industry, over time, if you look at our PMS alpha, is probably lesser, especially in context of the magnitude of alpha generated, lesser volatility. Still PMS will likely have more volatility of alpha compared to the mutual fund.
Thanks a lot, Prashant. One last quick comment on the Digital Leaders portfolio that we started earlier this year. How do you see the strategy evolving, the composite portfolio next 3 to 5 years?
See, Digital Leaders is a segment, a sub-segment of the overall Flexi Cap, which is to particularly companies that have leveraged technology really well, companies that are at the heart of this whole technology era that we are living through, the new age tech companies, as well as traditional tech companies that are enablers of new age tech companies, as well as companies that are leveraging technology very well. So it is more of a sub-segment of the overall portfolio. It will be likely more volatile in terms of alpha, but very consciously so, that the alpha volatility, because it's not as diversified, is more focused on a sub-segment. So it will be more volatile alpha is to be expected. And the performance overall would be also correlated to how technology as a sector does. NASDAQ would be correlated to NASDAQ as well, because it's fairly tech heavy.
Great. Thanks so much, Prashant, Rohit, and Parag. With that, we'll end today's session. Thank you, everybody, for joining and taking the time and for your participation. We look forward to again connecting next quarter.
Thank you, everyone, for joining. Have a great weekend. Thank you.
Thank you. Have a great weekend. Thank you.